If I had to start buying stocks right now from a clean slate, knowing what I know about this rebound, this earnings setup, and the fear that just got washed through this market, I would not be thinking about it the way most people do. Most people see a green day and think the pain is over, or a sell-off and think the crash is here. That's not really how this works. What we're looking at right now is a market that just got punched in the mouth, stood back up, and is now forcing everybody to decide whether they believe in growth again or whether they think this whole move is just another head fake. It's Tuesday, April 14th in New York, and comment below what day and date you're watching from. And real quick, if you get value from the way I break this stuff down, subscribe and comment John A.G. Best so I know you're part of the real community here. Because here's the thing, a lot of people got spooked out of good names for bad reasons. Not every stock, no. Not every chart, absolutely not. But a lot of the damage we just watched in software and growth came from panic, narrative pressure, and people acting like artificial intelligence was going to vaporize every existing business by next week. Markets love exaggeration. They always have. And then one day the same market wakes up, looks around, and says, wait a second, maybe that got a little ridiculous. That's why this rebound matters. Not because one green session fixes everything. It doesn't. Iran headlines still matter. Oil still matters. Earnings still matter a lot. But when software leads on a day when people had every excuse to stay defensive, that tells you something. It tells you money is still willing to rotate back into risk when the story gets even slightly less ugly. Miss that signal, and you can end up waiting for perfect clarity while the market keeps moving without you. So in this video, I'm going to walk you through what I think is actually happening, why some of these names suddenly look interesting again, why a few still look dangerous even after the bounce, and which kinds of stocks I would be focusing on right now if I wanted upside without losing my mind every time the market opens. Because there are opportunities here. But they are not all equal. Some of these are businesses, some of these are stories, and if you don't know the difference, this market will teach you the hard way. Now let's start with the big picture, because the big picture is where people usually get fooled first. The broad tape looked way better, green all over the board. Software showed real leadership, and the move wasn't coming out of nowhere either. From recent market updates, the major indexes pushed higher again on Monday, with the broad market up about 1%, the Nasdaq up a bit more than that, and software posting its best one-day jump in roughly a year, while Oracle ripped by low double digits. Now that doesn't automatically mean straight line higher from here. Let me be very clear. A sharp bounce after a hard drop can be real, or it can be a trap. Both happen. The part that gets my attention is not just that software bounced. It's which names bounced and why investors cared again. Oracle wasn't just randomly green. According to the latest publicly available filings, management recently held its guidance steady for this year and even raised next year's revenue target, while its remaining performance obligations exploded higher. That doesn't sound like a business being replaced tomorrow. And that gets us to the first big idea. I think a lot of the recent software weakness was narrative-driven more than business-driven. That does not mean every software company is safe. It does not mean AI can't pressure margins, commoditize features, or force weaker players into the dirt. It can. It probably will. Here's the counterpoint people need to hear. Some software companies really are vulnerable. Some have weak moats and management teams talking about AI like it's a magic spell. Those names deserve trouble, but the market started acting like the whole group was guilty, and that's usually where the best rebounds come from. That's also why earnings season matters so much right now. Based on recently published numbers, analysts are still looking for strong profit growth from the index this year, and technology is expected to carry a huge chunk of that load. So the next few weeks are not just about who beats by a penny. This is about whether management teams confirm demand, spending, guidance, and durability. If they do, this rebound can keep stretching. If they don't, the market will punish disappointment fast. You could see it in the usual suspects too. Salesforce was strong, Palantir bounced, and even the broader AI trade started breathing again instead of trading like every future dollar had just vanished. So am I bullish? Broadly, yes. Blindly, no. I think the market still wants to go higher. I think too much money is parked in fear. I think plenty of institutions got underexposed during the pullback. And I think when geopolitical stress stops getting worse for even a minute, money starts hunting for growth again. But I also think people are getting a little too comfortable saying every dip is a gift. That's how you end up buying the wrong stock in the right sector. Take Shopify. This is one of the cleaner rebound candidates to me because the business still looks real. According to the latest publicly available filings, Shopify just put up revenue growth around the low 30s for the fourth quarter, delivered roughly $2 billion in free cash flow for the full year, and announced a share repurchase program around that same size. That is not a company falling apart. So if the chart got shoved lower because people were de-risking software altogether, yes, this is the kind of name that can snap back hard when confidence returns. Would I chase it in a straight line after one good day? No. But if you're asking whether the setup can improve from here, yes, absolutely. You've got growth, cash generation, and a business model that still benefits from merchants wanting more tools and reach. And by the way, that last part matters. AI isn't only a threat. For some companies, AI becomes an add-on, an efficiency layer, or a way to deepen the relationship with customers. That's why the simple AI kills software trade was always too neat. Then you've got names like that infrastructure software play everybody was asking about. I actually think the buyback there matters more than people realize. When management is willing to authorize a repurchase big enough to make the market pay attention, they're not doing that because they hate the stock. They're doing it because they think the market is asleep. So if the company already had a business, got hit with the same theme-driven selling, and now management is leaning in, that's the kind of thing I want on my watch list because the risk-reward starts changing. Now compare that with Tesla, because Tesla is a very different conversation. Tesla is not a clean software rebound story. It is a battlefield. You've got the car business, the autonomy story, the robot story, the energy story, the brand story, and then the sentiment circus stacked on top of all of it. From recent company updates, first quarter production came in a little above 400,000 vehicles, but deliveries were closer to the upper 300s, and the earnings call is set for later this month. That gap matters. It tells you inventory and demand are still part of the conversation whether bulls want to admit it or not. Now, could Tesla bounce? Of course it could. It's Tesla. That stock can turn on a dime and rip your face off if you're leaning the wrong way. But if you're asking me whether it's the obvious buy right here compared with some other rebound names, I don't think so. There are too many unresolved questions. The lower cost vehicle plan might help volume, but it could pressure margins. The autonomy story is exciting, but it still needs proving. With competition getting uglier, I'd rather wait for a cleaner spot than pretend volatility is a thesis. That's the theme with a lot of the smaller speculative names too. I'll give you a few buckets here. Space-adjacent names with tiny market caps? Interesting, but often retail-driven. Rare earth names? Strategic theme, yes, but still early, still news-sensitive, and still not the same thing as mature cash flow businesses. Biotech and medtech? Massive upside when milestones hit, but you are not buying certainty there. You are buying a pathway, and pathways can get blocked. That's why a name like Huma can look unbelievably cheap on upside math and still be brutally risky if the path slips. Rare earths are a good example because the theme is real, even when the stocks get messy. According to recent company announcements, one domestic rare earth player just commissioned commercial magnet production in Oklahoma and said customer orders should begin this quarter, while also broadening its overseas processing ambitions. So the strategic backdrop is not fake. The West genuinely wants more control over processing, magnets, and industrial supply chains. But that still doesn't mean every rare earth stock is automatically a winner. Great theme, wrong execution, that's how people get trapped for years. Same thing with Navitas. This one is speculative, but at least the story has some current industrial relevance. From the latest filings, they've been pushing new gallium nitride products into data center power architectures, moving silicon carbide products forward, and expanding U.S. manufacturing partnerships. That gives the chart something to work with. It's not just a message board dream. Still risky, yes. Still needing proof, yes. But there's a difference between risky with a roadmap and risky because the internet got excited. If you're successful, share your success story in the comments so others can stay motivated. Now let's talk about the names where I think people should calm down a little. HIMS is interesting, but it is also one of those stocks where traders can overpower the underlying story in the short run. The weight loss angle got everybody emotional, then the strategy shift confused people, then the stock started whipping around again. According to company updates from last month, HIMS moved toward a broader mix of approved GLP-1 offerings through a partnership while keeping compounded access only for a narrower customer set, and the company has now set its next earnings report for early May. So yes, there is a real operating story here. But when sentiment, shorts, and momentum traders are involved, price can disconnect from business for stretches of time. That doesn't make it uninvestable. Just don't confuse a squeeze with proof. Then there's Intuitive Surgical, which to me is one of the easiest examples of why expensive and overvalued are not the same word. Based on recent filings, the company entered this year with roughly $9 billion in cash and investments, guided to mid-teens procedure growth, and recently got cardiac clearance for its newest Da Vinci platform. That's why the market pays up. Category leader, real cash, real adoption. So if that stock pulls back while weaker retailers or lower quality names just look statistically cheap, I know which side of that comparison I'm taking. And speaking of that comparison, this is where people get burned by simple valuation. A retailer like Target can look cheap because the market has already figured out the business is losing share and lacks momentum. A premium medtech name can look expensive because it keeps earning that premium. Cheap alone is not a catalyst. Sometimes cheap is just the market sending you a warning in plain English. Now let's hit Amprius, because this one has been a monster mover and I understand why people are asking whether to ring the register. I'm still constructive there, but I also think common sense matters. According to the company's latest outlook, revenue this year is expected to come in at least roughly $125 million, with losses narrowing sharply and adjusted profitability moving into positive territory. That's real progress. But when a stock has already delivered huge gains for early buyers, taking some off and tightening risk is not weakness, it's discipline. You do not have to marry every winner. And this is where I want to slow down for a second, because I know what happens when markets rebound. People suddenly want 10 tickers, 20 tickers, 50 tickers. They want the secret one. Let me save you some pain. You usually do better owning a handful of understandable ideas than chasing a basket of tiny lottery tickets because they all could go up. There is a difference between opportunity and randomness. So what are we buying right now? If I'm building from this setup, I want three things. First, real businesses that got sold harder than the fundamentals deserved. That puts certain software names high on the list. Second, selected growth names with current catalysts. That brings in names like Shopify, chip power exposure, and high-quality medtech on pullbacks. Third, a very small sleeve for speculative ideas where the theme is strong enough to matter, like rare earth processing or advanced batteries, but only if I'm willing to manage the position like it owes me nothing. What am I not doing? I'm not pretending every bounce is leadership. I'm not buying a stock just because chat loves the ticker. I'm not confusing a ceasefire headline, a short squeeze, or a one-day candle with a complete investment thesis. And I'm definitely not ignoring earnings. The market is basically telling us the next chapter right now. Fine, I'll give growth another shot, but you better show me the numbers. That's the deal. So yes, I think the rebound is here. I think it can carry further. I think software, selective semis, and quality growth are in better shape than people believed a week ago. I also think some of the most exciting stories in this market are still speculation wearing a nice jacket. You need to know which is which. And one more thing before I let you go. Tomorrow evening we're showing you the new studio, and that premieres at 6:30 Eastern, 5:30 Central, so be there for that. Drop your favorite rebound stock in the comments and tell me this too. Are you buying the leaders here, or are you hunting the names that haven't moved yet? The market doesn't usually reward the loudest opinion. It rewards the clearest process. Stay flexible, stay sharp, and remember, this is for education and discussion so you can think better about your own decisions, not a personalized financial plan or a command to buy anything.